Hello there. Thank you for choosing to view this video. In this video, I will be sharing some high-level details about various options available to self-employed individuals as far as mortgage financing is considered. Hope you enjoy this video. Do share your comments and feedback so that I can keep improving the content for you. A quick disclaimer, this video is being provided for general information purposes only and does not constitute legal or professional advice. No user should act on the basis of any material contained in this video or webinar without obtaining proper legal and other professional advice specific to their situation. Okay, so this is the agenda that we will cover in this video. We will just quickly review the definition of self-employed and make sure that you are in compliance with how CRA or the different lenders look at it. We'll also review some of the forms of self-employment, the framework used by lenders to evaluate mortgage applications, look at some of the options available with different kinds of mortgages. We'll also review a cool example as far as structuring tax and the mortgage is considered, as well as some special programs available for select professionals. Before we dig in, a quick intro about myself for those who don't know me. I'm a licensed mortgage agent in the province of Ontario, Canada, and I'm associated, or rather not associated with any lender. I have access to all lenders in the broker channel, which includes a couple of big banks and monoline lenders and credit unions. This enables me to offer the most appropriate solution to my clients rather than having to force fit them into a limited product suite from a single lender. Okay, I think that's pretty much enough as far as introduction is considered. Let's dig right into the agenda. So first up, we will quickly review what does it mean to be self-employed. So this used to be a very clear-cut term, but given the rise of the gig economy, meaning Uber and Lyft and all these food delivery companies, it is very difficult to figure out get a clear-cut and straight answer in terms of what is your employment status. Moreover, many employers are trying to cut costs, and so it is increasingly confusing in the 21st century. So let us review as to what does CRA and the lenders use to define the status of an individual. So there are two key aspects that CRA or Canada Revenue Agency looks at to determine if an individual is an employee or self-employed. And by extension, lenders also tend to use the definition so that they are evaluating an application for a mortgage appropriately. This is very important so that a set of applicable documents can vary based on whether one qualifies as an employee or self-employed. So first off, one needs to determine if one is bound by a contract of service or a contract of services. If former, then by definition, the employee or the individual is an employee, as he or she is in service for the payer or the employee. However, if an individual is in a contract to deliver a set of services, so rather contract for services, and nothing beyond or short of it, then they are self-employed or specifically an independent contractor. This confusion generally arises when one is offering services to a large organization in their individual capacity. There are a few more questions that one can answer to determine their status or situation, like the level of control that the payer or the employer has over the worker's activities, whether the worker or payer provides the tools and the equipment, whether the worker can subcontract or pass on the work to somebody else who can do the work instead, the degree of financial risk that the worker takes on to do that job for the payer, the degree of responsibility for investment and the management that the worker holds, the worker's opportunity for profit, and other relevant factors such as written contracts. Now, this might, if you're feeling a bit more constrained when answering these questions, it is most likely that you are in an employee-employer situation and don't really qualify as a self-employed. So I guess this should help you make that determination. And if so, if you qualify as a self-employed, the rest of the video would be much more appropriate in terms of what options are available as far as mortgage financing is considered. Okay, now let's look at some of the various forms of self-employment um, uh, and determine as to what documents are applicable in each instance. So as a self-employed, you could be organized or be termed as an independent contractor. Independent contractors are businesses or individuals hired to do a specific job. They receive payment only for the jobs that they do. Because they are not considered employees, they do not receive benefits or worker compensation. Their clients do not withhold taxes from the payments that are received for the work performed, and equal opportunity laws do not apply to them. The primary documents applicable for such individuals would be T4A documents, T1 generals, and the notice of assessment. And you would probably need it for a couple of years, usually 2 years. Next up, we have sole proprietors, and this has been the sort of the traditional model for self-employment as an individual or as a business owner. The owner of the business, for instance, may again hire employees and essentially become the boss, an employee owner who operates and manages the business. A sole proprietor, also referred to as a sole trader or proprietor, is an unincorporated business that has just one owner who pays personal income tax and profits earned from the business. In this form, the individual and the business are one and the same, and there is endless liability. For example, the debts of the sole proprietorship are also the debts of the owner. However, the profits of the sole proprietorship are also the profits of the owner, as all profits flow directly to the business's owner. Now, the primary documents in such a situation would be your T1 generals and the notice of assessment, again for the last 2 years. And generally, lenders have a requirement that a certain employee of self-employed or a business owner has been in business for 24 months at least. So it's good to have about 2 years of tax documents handy to be in the most comfortable situation. Third, we have the partnership. A partnership is a formal agreement or an arrangement by 2 or more parties to manage and operate a business and share in its profits and losses. There are several types of partnership arrangements. In particular, in the partnership business, all partners share liabilities and profits equally, while in others, partners may have limited liability. There are also something called silent partners, in which one party is not involved in the day-to-day operations of the business, but is just contributed in some form, and usually it is capital. In its most basic form, a partnership, all partners share the profit, loss, assets, and debts, their share being defined by the percentage of ownership in the partnership. The entire share of a partner's income is considered personal income, and one has to pay tax on it. The primary documents in such a situation would again be T1 generals, the full T1 generals, and the notice of assessment, again for a period of 2 years. I think last up we have corporation. Now, corporation is a legal entity that is separate and distinct from its owners. For one, the corporation enjoys most of the rights and responsibilities that individuals possess. They can enter into contracts, loan and borrow money, sue and be sued, hire employees, own assets, and pay taxes. Some even refer to it as a legal person. As the owners are distinct from a corporation, they have to draw an income or their share of the profit in the form of a salary, bonus, interest on loan, or dividend. And the applicable documents in this situation could be T4 if you are getting salary, or T4A, or T5 statements if you are drawing dividend or interest income, and also T1 journals and NOA. The documents of the corporation would be that would be required as the articles of incorporation to prove ownership and the share of the ownership, the financial statements, and maybe even statements of business bank accounts, depending on what kind of mortgage you're applying for. So this is, in essence, the various forms of self-employment, how it is structured, and what documents might be required for you to get a mortgage. Now, let's look at it from a lender's perspective and see as to how do they explore or what framework do they use to adjudicate on a mortgage application. So this framework is generally called as the 5 C's of credit, as there are 5 key aspects, and we'll explore them in detail, starting with collateral. So collateral is in effect the property type, the location of the property, and the market value of the property in question. Before lending on a property, the lender will want to ensure that the property is in appropriate condition and that is indeed as valuable as is being suggested by means of a purchase agreement or as stated as property value on a refinance or a transfer application. The most common way to evaluate value is by means of a property appraisal. This might also include an assessment of the market rents if it is a rental property. Okay. Next up, we have the credit profile of the borrowers. Here, the lender will investigate to check the past credit history of the borrowers and look for signs of credit mismanagement or management. This can take the form of late payments, defaults, consumer proposal, bankruptcies, etc. In addition, the lender will also look at existing debt obligations of the borrower. Third up, we have the capital that the borrowers have. This capital could be in the form of a down payment in case of a purchase or existing equity in the case of refinance or of a mortgage transfer. Generally speaking, the lenders are more comfortable as the mortgage or the loan amount decreases as compared to the value of the property. To some degree, this also could translate to better pricing for the mortgage. Next, we have the character of the borrowers. The lender will also be very keen to see as to what kind of track record the borrowers have as far as employment, business history, past credit related behavior, and their public records. And last up, we have the fifth and the final aspect, which is income or ability to repay. This is very key important aspect, which the lender will want have a high degree of confidence so that they will be able to recoup the money with appropriate interest without undue struggle. While all the previously discussed aspects are common for all borrowers, this particular one tends to be different when considering borrowers who are employees versus borrowers who are self-employed. All lenders associate a certain degree of uncertainty when reviewing the income profile of a self-employed individual, and hence they require a longer income history, and also they also evaluate the trend of the income, whether it's been steady, increasing, or indeed decreasing. Given that the income can also witness fluctuations over years, it might very well be the case that the mortgage eligibility will also fluctuate depending on when the mortgage is being applied for. So with this solid background, let us now explore the various mortgage options available to self-employed at a high level. Now, as an entrepreneur or a business owner, you benefit from income tax credits and great reductions and write-offs on your personal tax return. This is a great advantage when it comes to actual amount of taxable income you have to pay tax on at the end of the year. But the disadvantage is your net income can be incredibly low as you are trying to pay lower tax. So this can impact qualifying for loans and mortgages, because when your taxable income is incredibly low, it becomes difficult for some lenders to feel confident that you earn enough income to be able to afford or to pay back the mortgage. So generally, you have two options then when securing a insured mortgage. And when I say insured mortgage, it means your purchase price is less than $1 million, and your down payment could be anywhere between 5% to 35%, depending on what kind of mortgage you're applying for. So in this scenario, you could either be fully qualified for the mortgage based on the income you're reporting for your tax purposes, or you might need something called as a non-income qualified mortgage. If you are able to fully qualify and prove your income, then your eligibility is no different from that of a salaried borrower. However, if you're going to rely on non-income qualified approach, then you could have restrictions like A minimum of 10% down payment required, or the mortgage amount could be restricted to just under $750,000 for an insured mortgage. So what exactly is a non-qualified income? Firstly, not all lenders entertain such an approach, but the ones who do rely on the income that you're reporting on your T1 journals, the NOA, and the business financial statements to arrive at a value which is usually in between your net business income and your gross personal income. And that value is considered as your eligible income for the purpose of qualifying you for a mortgage. The best, this is in fact the best because you can get the same interest and the terms that are generally available to salaried employees, but all of this, of course, is under an insured program wherein you would pay mortgage insurance. This is usually available for purchases and mortgage switches or transfers, but does not exist to refinances. Okay. Now that we have explored insured mortgages, or typically for properties that are valued under $1 million, let us look at other scenarios where the property is probably over $1 million, or what options are available to you in that case. Okay, so in this scenario or the case, there are no issues if you are able to declare sufficient income on your tax returns and can fully qualify based on it for the mortgage you want. However, since the benefit of the mortgage insurance does not exist or extend to properties over $1 million of value or purchase price, none of the prime lenders will refinance a mortgage even if the property value is less than $1 million, or approve a purchase or a transfer if it is more than $1 million. So unless you are showing or reporting that much of income, qualifying income in your tax returns, prime lenders are not an option anymore. But you can, in such scenarios where you want to refinance an existing mortgage or purchase over a property over $1 million, or switch a mortgage from on a property purchase after 2016, the only options are with alternate lenders or non-income qualifying mortgages at some credit unions. The prices of these mortgages or the interest rate on these mortgages tend to be slightly higher, but they can be very good options. And I have an interesting example to review so that you can visualize as to how it might make sense if it is applicable to your case. So let's assume that you are interested in buying a property valued at about 1.2 million, and with a down payment of say about 20%, you're looking for a mortgage of about 960,000. Okay. In this case, if you are a salaried employee, or you and your partner are both salaried, you need a gross household income of about 156,000 to qualify for this mortgage, as per the qualifying guidelines as of today. That is May to 2021. Now, in case you individually earn that much, it would put you in a marginal tax bracket of about 48.29% if you are a resident of Ontario, which means that you would pay an annual tax of about 48,000. In the other scenario, if you are as a couple making 156,000, then in the best scenario, your total tax, the best scenario as far as your total tax is considered, you are probably making about 78,000 each. And so your tax bracket is going to be about 29.65% in Ontario, with an associated minimum tax outgo of about $32,000 combined. Obviously, this is assuming that you are not making any RRSP contributions to bring the taxable income down. Okay. So as of today, then you would be looking at a best case scenario wherein you will pay about $21,500 in interest cost on average per year for a 5-year term. And I've considered a 5-year fixed mortgage for this example. So your total tax total outgo when combining your tax that you pay and the interest cost is going to be about 54,000 to 70,000 per year, depending on where exactly your incomes lie. Okay, so 54,000 at least versus 70,000 at a stretch. Now let us see as to what could be the scenario when it comes to a self-employed individual who has organized his business under a corporation. Okay, now let's assume, of course, that the same income is available. So 156,000 is available as net income for the business, not necessarily in the individual's hand, but as net income from the business or in the financial statements of the business. As a financially savvy individual, you would obviously have not drawn the entirety of it as your personal income, but probably have retained about 50% of it in the corporation to be extracted later on a tax deferred basis post retirement, when generally your income is supposed to be lower than what you probably have today. In such scenario, you would pay about 17,000 in personal income tax. For sure, there is other tax that corporation will pay, but at an individual level, you're probably paying about 17,000 personal tax, assuming that there are no contributions to RRS. Okay. A comparable mortgage of the same size, which is 960,000, from an alternate lender or a credit union using non-income qualifying guidelines would obviously cost higher than what is available at a prime lender. Okay, so we are anticipating about $35,000 per year in interest cost, including fees, for a 5-year mortgage, again fixed rate mortgage. So obviously the interest costs are going to be higher, but when you look at it from a holistic standpoint, which is what is your tax outflow plus the interest cost, you would find that it is probably going to be lower at about 52,000 as compared to a range of 53,000 to 70,000 for a salaried employee. Okay, so it might still make sense for you depending on how and where you're drawing your or you're structuring your income as a self-employed. So I think that this is very interesting because instead of just ignoring what options could be available with alternate lenders, if you're self-employed, it might make actually much more financial sense for you to get a mortgage from an alternate lender rather than drawing more income in your personal name and paying a higher tax on it. I think you would probably have liked this example. Okay, so this is something that I wanted to highlight. But before we jump into exploring some of the other options which could be available for some self-employed professionals. Now, some of the lenders have specialized programs for professionals like physicians, dentists, and veterinarians, wherein the lender would be willing to consider projected future income and use that for a qualification. So not necessarily that the individual is already earning that much income, but the lender would be willing to consider the projected income. Again, they have certain guidelines and values that they would consider. If this is an option or could be a great resource for this professionals who are probably in the residency period or doing the final year of study. There are also some other special mortgages or products available wherein the borrower who has financial assets in the personal name or assets in a holding company, not operating company, then that can be used to qualify for a mortgage. It might come with some restrictions as far as products properties are concerned. You may not be able to buy a rental property or investment property. And also there could be some restrictions around refinance. But again, these are some of the programs or features which are available with some lenders to help you qualify for a mortgage. So with this, we have sort of come to the end of this video. I hope you like the content of this video, and if so, you can find much more such videos on my YouTube channel or Facebook page. Also, if you have any queries, feel free to reach out to me at the phone number and email address provided. I hope to see you soon on another video.